Awesome, thanks guys. So I've actually been advising the Ethereum Foundation on their grants program and researching the decentralized finance ecosystem and the traditional finance ecosystem and trying to figure out where we'll see adoption first and what these use cases will need from a layer one. So I'm really excited to learn more about how close we are. So before we get into that, I want to kind of poll the audience. How many people here are excited about securities tokens? You put your hand up. Okay, we got like 30% maybe. It's hard to see from here. How many people are skeptical about securities tokens? Good, half and half. This is going to be a good panel then. We'll get controversial. I can't really see that well, but is there anything you guys want to cover just to make sure we keep things exciting? If anyone wants to put up their hand and or shout out a term before we get started. Yeah, back there. Say again? Yeah, awesome. Anything else? Privacy? Others? What was that? Centralization. Okay. Quants? Quants. Okay, cool. Well, anyway, we'll start here, and then we'll kick it back to the audience for some Q&A at the end. And so we're just going to go around and think like, what is the current state of security tokens? And we'll get a bunch of different viewpoints from exchanges, issuance platforms, and from the regulatory side. So today, Connor, what does the regulation look like around securities tokens?
So I think it's important to distinguish at the beginning from what we might call smart securities, like traditional securities that have been tokenized, equity that's been tokenized, for instance, and network tokens that are or are not securities. And so it's pretty confusing, and a lot of these platforms may be dealing with both. But where we're at right now from a US regulatory perspective is that the SEC is probably not going to make big moves. So the SEC's Director Hinman came out a few months ago and said that transactions in Ether don't appear to be securities transactions. And one of the big reasons he cited that was because of Ether's decentralization, without going into details about what decentralization meant, of course. But from what we're seeing now, we don't know that the SEC will make moves without policymakers making moves. So that means Congress of the United States making a decision. So about 3 weeks ago, a Republican congressman hosted a roundtable. And that roundtable was attended by almost every major exchange and Consensus, and traditional players like Fidelity were there. NASDAQ was there. And it was a discussion around what they wanted to see, what kind of clarity they needed in order to kind of best operate their businesses in the US. A big theme of the event was everyone saying, you know what, if the US doesn't change really quickly, then we're going to lose a lot of the market to other countries that have more crypto-favorable legislation. So Congressman Davidson, Republican, but he was joined by 3 other Republicans and a Democrat, and they were very bullish on crypto, and their proposal, I think, that it's going to come this quarter to Congress is going to be very pro-crypto. So that might start that way and wash out a little bit and become a little bit more pro-regulator, but we think it's a really good start.
So in your opinion now, from a regulatory perspective, is it possible to launch a securities token?
Yeah, it's possible to launch a securities token using, it sounds like there's been a registered securities token. We're talking about T0. You could use 506C to launch a securities token. It doesn't sound like any reg, to my knowledge, and I think we were discussing earlier, there's no reg A+. So these are all different securities exemptions. So for instance, 506C allows you to like accredited investors to invest, but then there's a time restriction, so they can't transfer that security for first 12 months. So there's a lot of downsides that we wouldn't want to see, especially on a network token. Like you could imagine if you sold all your network tokens and they just had to hold on to them for 12 months, it would really impact the usability of your platform. So you could do a launch right now, but not as effectively as I think a lot of folks in the blockchain space would want to see.
That being said, what is interesting is that you can do a launch now. So, with that, let's turn it over to Corbin and talk a bit about the issuance side of things.
Yeah, so on the issuance side, I think we have, tens of different security tokens that have kind of announced and launched kind of around the world. Everybody wants to be the first, right? They want to be the first tokenized, soccer team in the UK and, get a big announcement from it. What I would mention too is a lot of these things are just private agreements, right? So this kind of exists today, right? You have a legal agreement and some kind of corporate entity that owns a particular asset, and only a private group of investors can participate in it. Today, those private investors kind of can't reallocate shares amongst themselves very easily. We did our first tokenization deal this past May, and the operator we worked with literally was keeping track of the cap table in an Excel spreadsheet, right? Which could be deleted, emailed around, get out of date very, very quickly. And so just transferring that cap table on chain, so it's visible to everybody, everybody's super aligned with who owns what, and then allowing those investors to trade back and forth, logging each trading event as well, in all honesty, offers a benefit over the traditional way of doing it without even needing regulatory approval to do something like that in a private transaction. So going back to where we are today, you're seeing a bunch of these issuances coming about. Institutions are looking at them, but they're not really comfortable with them yet. We can get into this later, but I think it's because of custody and because the exchanges kind of haven't launched yet. I think you'll continue to see a lot of kind of these private deals being done kind of in the next year or so, especially amongst kind of like smaller investors. And then I hope to see the trading venues to really start popping up inside the US or other places around the world where the regulatory bodies are a little bit faster acting. That is my hope.
So question for you on the issuance side then. What are some of the type of assets that you're looking at or you think will come to market first on the Meridio platform?
Yeah, that's a great question. So for Meridio specifically, we are very narrowly focused on assets. We totally agree with tokenizing the world, but we want to start with one of the assets we think will benefit the most from it, and that's real estate. So real estate has high transaction costs. It has very, very low access. Like all of us, it's hard for us to get access to an amazing deal in Manhattan and New York. And then liquidity isn't there, right? All of those things are things that blockchain can kind of help out with. I do think that, so we're, to answer your question, individual assets or funds of real estate assets are kind of what we're focused on first. And it's going to be the things that people kind of want to trade in and out of relatively frequently. So it could be flagship assets, it could be large assets, it could be REITs that are a bundle of assets, but all just using the new blockchain kind of rails as the issuance mechanism.
Awesome. Thomas, let's move on.
Yeah, definitely. Is that working? Yeah, okay. Yeah, so we're definitely seeing some real estate, just like Corbin mentioned. What we see as well is as funds, VC funds tokenizing themselves, as well as equity. You mentioned early on, the ability to digitize the cap table as a great starting point. We've seen quite a bit of that as well. One point on the Reg A pluses. What's been very interesting is a lot of the issuers that have come to our platform started with the Reg A plus and with the SEC sitting on them for 6, 7, 8 months, not emitting an opinion, no positive, no negative, nothing, just being completely silent. They're redirecting themselves towards the Reg D, so more of a private placement, because as a private corporation looking to raise funds to grow, they can't wait for the SEC forever, right? And so they've tokenized the cap table, they're looking to do private placements, looking to do those private placements not just in the US, but internationally as well, so doing a Reg D and a Reg S, at which point the lockup ends up being 90 days for a person outside of the US. So we're seeing some traction there, as well as interest from exchanges outside of the US that want to be able to trade after the 90 days.
So I want to go back to something you said about VCs tokenizing. And so for people here, what are some of the benefits that you're seeing? Because I think, a lot of these things work somewhat effectively in the real traditional world today. So there's debate around, why is this actually adding value to the process of raising capital for a VC?
Yeah, so partial ownership, being able to have a lower entry ticket has been seen as good value. Efficiency around dividend distribution as well. Being able to distribute dividends to 100, 1,000, and we were just talking about that a moment ago, being able to do that on chain, right? And so just having a smart contract, all your investors are there, you just throw money at the smart contract and it breaks it up adequately, deducts tax withholdings for you, because that's another. We talk about dividends distribution a lot, but another big challenge with any sort of cash event is all the tax withholdings that come with it. Right, and so having the ability to automate all that from an efficiency and funds distribution perspective is phenomenal.
So in terms of Polymath and where you guys are today, have you issued any tokens? What are sort of the next steps in the near term?
Yep. So where we are, we've been live for a couple of months now. If you look at our contracts, we've had 31 tokens being created on the platform. One of which was a mainnet test. So 30 non-Polymath tokens were created. In terms of dividend distribution, we've created the modules to do that with the tax withholdings as well. So we've built a very modular token, if you will, that's cross-jurisdictional and cross-instrument. In other words, you can, based on the instrument that you have, associate the trading restrictions that you need, the volume restrictions that you need, so that you can do your token distribution out. It's rooted in KYC AML, so you know who all your investors are, and all the transfer restrictions are enforced directly on chain. So that brings transparency from an investor's perspective, because they can see whether or not what they're going to be able to do with that token once they acquire it. They can also see, disclosure information that gets posted on chain as well through, IPFS or document sharing that gets directly written into the token as well. So you have this sort of very much improved visibility from an investor's perspective. The modularized aspect of being able to trade different instruments across jurisdiction in a very flexible way and very transparent way as well.
Yeah, so one of the points that Thomas hit on that I really want to kind of emphasize is the modularity of these things. A lot of times we talk about security tokens, and security tokens, it's like it's going to be another ERC20 token, right? The nature of the underlying security is going to dictate the type of libraries and other modules you add to each individual contract. It's not one size fits all. It's the opposite of one size fits all. But it's also an opportunity for us to use kind of the smart contract capabilities of a blockchain. So we were talking about this earlier, where with traditional security, or with interest in a VC, right? Second market's been around for years, right? You could trade Facebook stock back and forth. A lot of the compliance and auditing requirements fall on the venue where that thing is being exchanged. With a smart contract, it actually lives with the tokens or digital shares themselves, right? So you don't have end of the year compliance processes and auditing processes. It's done, all those rules are checked every single time that a transfer takes place. You're checking for investor accreditation, but you're also checking for things like investor caps, or minimum amount that you have to own to be an investor in that asset, maximum amount. So in some types of securities, a foreign investor can't own more than 50%. All these types of rules that traditionally sit in a legal agreement that barely anybody but the lawyers read are now literally code that sits in the token contract itself. And that's really exciting.
Awesome. So I'll move over to Ron. If you could give us an update on, where's the exchange landscape now? What does the regulation look like around being a licensed exchange to trade securities tokens?
So for Paradex, a couple of things come to mind related to the discussion. We've been very deliberate about maintaining non-custodianship as one of our core principles. I think that extends to customer data, so in this case, equity owner data or shareholder data. Obviously, we'd be non-custodial to the assets themselves. So those are things that enforce privacy and user empowerment, not having more data than you need. And then on the token issuance side, we've also tried to be very agnostic to the type of token. So as an exchange platform with ERC20 compatibility and some of the like tokens, we would hope to be able to provide really efficient trading services for these things. That being said, there's not a lot of demand for high volatility security tokens at this time. So the real benefits of what we consider Paradex to be an efficient exchange, almost like a centralized trading experience, wouldn't really shine through quite yet. So for us, the attitude is security tokens are ultimately going to be amazing and very important. They're super accessible for mainstream adoption, but it's early. So it's something that we are definitely going to participate in when the time is right, and it's not going to be as quickly as we all think.
So just on that point, you mentioned speed. What are some of the key hurdles that we need to overcome before you see adoption?
Yeah, so I think part of it is, what we've discussed already is that these securities are becoming very granular in definition, and they don't suit, this widespread ability to support liquidity by professional liquidity providers or necessarily even demand. It's, private deals that are using a more efficient distribution structure, We talk about Ethereum as programmable money. Security tokens would be programmable securities. So, some built-in functionality for dividend issuance, for communication timings, for the number of shareholders and things like that. They're all great and important, but none of those things are like, 100 ounces of gold, which, has 7 trillion market cap and, trades as a very standardized, highly liquid, sometimes volatile commodity. So security tokens, they're individual, they're unique, or somewhat unique. I mean, there's similar characteristics to some, but the use case for trading Apple or Amazon isn't quite there yet.
So let's get into it now, because it sounds like the tech is ready. Some items have been launched. The regulations are somewhat set. So this stuff can be done and it exists, but in my mind, where is the liquidity going to come from? And that's the first question somebody asked. So to ask the hard question, you have liquidity made up in traditional markets from institutional investors, then high net worth retail investors. And in this case, institutional investors may or may not be comfortable. Sounds like it's really a race to capture the high net worth accredited investor. Can you guys talk about where you see the demand coming from in the near term?
Yeah, so where we see the demand coming from is more on the mid-tier accredited investors, not the high-end, not the large institutional investors. They're still trying to come to terms with a lot of AML, particularly on crypto itself. I mean, they source their Bitcoin and their Ether directly from the miners so that they don't have concerns over AML. So they're still looking, at least from the ones we've seen, they're still looking at some of the challenges brought to bear by a public ledger, right? The Ethereum blockchain, for example, with the possibility for people to learn about their positions, for example, rights around privacy, for example, those are seen as potential challenges. But I think one of the other barriers to entry that we see, and I just wanted to bounce on what Corbin and Ron was saying, is the modularity has a tremendous impact on the user experience. And I think this is where everyone here can help, which is if you think about a traditional utility token, there's 2 reasons why your transfer is going to fail. Out of gas, insufficient balance. When you think about a security token, with all those different modules, there's dozens of reasons why it can fail. It can fail because you were going to hit the maximum number of investors, you were going to hit the maximum percentage ownership, you hit the maximum daily trading volume, the maximum 90 days trading volume. And all this translates into reverted. So how the hell do you know, right? Without like a ERC 1066 to have proper status code so that as an investor, I know what the rules are around the smart contract. I know what is associated with trading that asset. I don't know why it failed, right? Unless I go through steps of verifying and checking, every single operation. And so I think, from access to capital and large institutional investors, there's some technical aspects that need to be tackled there. But even for broader adoption, there's some very, very simple things like user experience that need to be addressed as well. And that's where all of us as a community can better that system and increase the level of adoption as well.
So I'll take us back to kind of the liquidity question, just because I get this all the time. I'm not surprised at all. It was the first thing that was thrown out. So, it's interesting, right? I do not take a build it and they will come kind of approach. I think you're going to have to bootstrap liquidity, and you're going to have to bootstrap a lot of these marketplaces, like you have to do with very low volume cryptocurrencies, right? Only kind of the top coins kind of trade in a liquid manner. If you're issuing a security token for a very specific office building in Brooklyn, there are only going to be a handful of individuals that are going to want to trade that back and forth. I do think in the short term that the demand is going to come from accredited investors, and those are just the regulatory hurdles that we kind of have to go through to make sure these things are compliant. I think it will be a good avenue to expand it based on some of the other filings you can kind of go to unaccredited investors. I think there is demand, and then we've seen that ever since the real estate crowdfunding kind of burst happened after the Jobs Act several years ago. There is a demand for holding these products, right? It's also a great store of cash. You can own, 1% of a real estate building, and then you get that rental income deposited straight into your Ethereum wallet every single month. It's not a bad thing to have.
So I just want to push back on that a little bit. The real estate platforms have been around for 6-7 years. So for those who don't know, there's platforms like Cadre where you as an individual can actually invest in fractionalized real estate. Beautiful interface, centralized, so super good user experience. And these haven't really driven a ton of demand. So what's it been like trying to get this mid-tier accredited investor? Have you guys been successful, and what has sort of worked building this demand?
Yeah, so I would say they haven't really been successful as like a rocket ship business, but they've certainly demonstrated that there's demand for users to use these types of things, right? It's they're networks by default, and so the top players in the real estate crowdfunding space have gathered the best assets and the best investors, and it's just kind of cyclical within their own little silo. Right? That's what excites me about what we're doing now. We're basically taking that silo, that AOL in 1996, and we're expanding it out. And so it's an entire platform that anybody can contribute to if you go through the right certifications. Down the road, you could have assets that are listed on multiple real estate crowdfunding sites, but then trade on all the same secondary exchange, right? They almost become issuance platforms. So I think it's going to be the next evolution of that business model in an open environment versus all these little siloed networks where only the top 3 or 4 have actually been successful.
Thomas, how do you feel about that?
We certainly see a lot of interest from accredited investors. I want to be very careful with the use of crowdfunding platform, right? Because the term crowdfunding, at least in my mind, I go Reg CF, $1,075,000 max raised, which isn't really.
Sure. Sorry, I was referring to Reg D issuances.
Yeah. So, in the context of Reg D, we're definitely seeing issuances at different stages of the fundraise. Some have made really good progress. Some are still, frankly, working through the challenge of the current market, right, which isn't really suitable for large investments. But there is certainly a tremendous amount of traction from both the sell side and the buy side around that, $5 to $50, $100 million fundraise, if you will. Once you get north of that, the air gets thinner and thinner and thinner.
Interesting. Another issue I kind of wanted to dig in, this is an open question, is the adverse selection problem. So you've seen this also with crowdfunding platforms where people who can't raise funds tend to go to these platforms as a last resort. I know that some issuance platforms are really controlling which assets are issued, and some issuance platforms are completely open. One problem that I potentially foresee is, in the next year or so, 500 buildings coming to market and these being kind of garbage in, garbage out assets. How do you guys protect against adverse selection and also protect investors in general? If you guys have...
that's more of a question for them.
Yeah, that's definitely true. I think there's a saying in the space where it's like, if you're seeing the deal, it's already like a tier C or D deal, something like that. And that's something we are very, very cognizant of. So we're on the cusp of what we believe is, this security token revolution. We have to really have strong quality controls from the beginning. Otherwise, you're going to get, a bunch of examples of really low quality assets, burning investors, just disappearing. And that could really tank us or set us back 3 years, right? Because regulatory bodies are then going to come down on you strong. So we have a really high bar quality filter for the operator and the asset owner that we're working with. They like it because it's very cutting edge and it's actually a good source of capital for them, rather than raising that capital from a bank or from some other big institution that might charge them or be a very active participant. This is an opportunity to raise from a large number of individuals that are going to be invested in that individual asset. And then also the way we structure them is it's an unopinionated ownership, right? So you sit back, you collect your dividend issuances, you participate in the upside of the asset, but you're not going to be an activist investor. So we see there definitely being a place for something like this.
So for us, we've taken a very different, not to say completely opposite approach of this, which is, we see sort of ranking of the products ourselves as a slippery slope towards becoming an investment bank. So essentially taking decentralization and re-centralizing it, on ourselves. So what the approach that we've taken is the platform itself is open. Anyone can go in, create the security token. We rely on a distributed network of advisory firms and law firms that are on the platform to be the gatekeepers as to the quality of the security tokens themselves. So essentially decentralizing, if you will, the quality of the products themselves. But we also see this as an opportunity to create new tools, to have the grander community, issuers, investors, other service providers, rate the quality of those financial products themselves through things like token created lists, for example. And the way we look at that is, if I take the traditional financial system, those rating agencies are extremely centralized. That's something that needs to get broken. That's something that needs to get completely decentralized. By having advisors already sort of curate the deals themselves and bring them to a decentralized platform for that security token issuance, we're taking the first step. The next step needs to be around how can we, in a completely decentralized way, have rating of financial products pre and post issuance as well. So if someone goes into any platform, ours, anybody else's, forks the code, creates their token, who cares? There has to be a way for the investors globally to look at some sort of a rating that didn't come up from one organization that was improperly incentivized to rate that product.
Yeah, can you talk a bit more about that? Somebody had mentioned decentralization as a topic or theme, and Polymath has been the most decentralized versus a number of issuance platforms that have been centralized. And so you're talking about, as a result of decentralization, you'll have more innovation, but also it comes with more issues for the user. So getting these institutional investors you mentioned might be more challenging. Can you talk about why the decision to be 100% decentralized was made?
I'm not sure that would be a challenge from an institutional investor's perspective, because it's still security we're dealing with, right? So there is a level of due diligence that is going to be made on the private placement memorandum, the prospectus, basically all the documentation that goes along with the security itself. And so large institutional investors can do the research to pick the right products. The challenge of decentralization is you have to pick the right partners within your ecosystem to build, to make sure that you have those strong products that get tokenized using that platform. So there is a risk there of having essentially bad products being associated with the platform. We've seen other issuance platforms go fully centralized. It's their decision. I mean, they effectively operate as an investment bank. We see ourselves as a software company. We see ourselves as a company that has found a way to enforce regulation in a decentralized way. Why would we re-centralize everything to then decentralize it again? Why not start decentralized, show that we can apply current regulation as is with a decentralized platform, and then go from there?
Corbin, do you want to respond to that?
Yeah, sure. I may not make too many friends on this one because I actually lean more towards the centralization side, at least for where we stand right now in 2018. So there are a lot of things that you could kind of decentralize about the issuance. I'm going to keep going back to real estate because that's kind of what I know best, right? So you could have, the smart contract could be community governed. The due diligence could be community contributed to, right? You could have validations or, reputation that drove the best due diligencers out there. You could have management of the property that was controlled by a slew of bounties to make sure that, your sink was fixed if it was leaky, and to make sure that windows were up to par, and to make sure you had a high occupancy rate. I don't think we're there yet. I don't think we're there where we can have everything about this ecosystem be completely decentralized. So I think it's important to find the things that are important to decentralize, like the cap table, like trading back and forth, like dividend issuance. And then keep, the centralized parties involved that have been doing this for years and years and are experts in doing these types of things. And then it's a baby step. And then over time, we can make more and more of this thing autonomous and decentralized and kind of run by itself. So I think you have to take baby steps and keep some centralization in there in the near term.
So on that point, if you're maintaining centralization and controlling a whitelist, for instance, you're talking about building liquidity. But if you're controlling a whitelist, how do you see this liquidity across issuance platforms? So, somebody who has registered and KYC'd with you guys, trading with somebody who has done the same with Harbor or with Polymath. Do you guys, and I mean, if you have an opinion on this also, see that fragmenting of the ecosystem is a problem for liquidity?
Yeah, I think it's a problem for liquidity, but I also think that, like, getting back to the regulatory point, like making sure that regulations exist, because we talk about potential benefit of this being like a global opportunity, and we want to make sure that there's harmonization between jurisdictions so that a lot of this stuff can work for the users. Because, I mean, as it exists now, I don't know that we'd have like that easy of a time making this a truly global product. On TPL's side, like from our perspective, we have essentially we have the protocol and the architecture for anyone to come in and develop their own what we call digital jurisdiction. So they could, depending on where they're from a particular jurisdiction that has a particular set of regulations around how it is that you transact in their security, how to stay compliant. They could build out validators that would validate that before a transfer occurs. Those securities legislations have been complied with. So it's ours is more of an open, and I don't, maybe yours is as well, I'm not totally sure, but ours is more open, I guess, in the sense that others can come in and participate in the way that makes sense to them based on what the regulatory standards are in their jurisdiction, and it can evolve as well as regulations evolve.
So we only have a couple minutes left, and I want to get some Q&A from the audience. But before we do that, one final question is just, where do you see this in 10 years? If there's securities tokens at scale, what type of innovations are you super excited about, and what might the world look like?
So one of the things I think is underrated and probably a gift to regulators is that there's never been more transparency available to compliance and regulatory bodies to track compliance and conformity with rules for issuance and ownership standards and things like that. So I think almost flipping it, the privacy is going to be less important than the transparency provided by doing this on blockchain. And I think once regulators realize that, we're going to open the floodgates a little bit wider.
Yeah, and I think even in 5 or potentially 10 years, we're going to see a lot of the same standards we see. Like we were talking about how, for instance, a Reg A Plus offering takes 8 months, probably more like 12 months, right, to get approved is what we're quoted at. And that still needs to exist to some extent. Like there are unaccredited investors who could be, there needs to be a balance certainly in appreciating, okay, we don't just need to provide people with rights as accredited investors because they have this much money and keep all the good deals away from those who are non-accredited. But we do need some level of consumer protection such that that not any security is able to offer. Like we want to make sure that when the blockchain legislation and policy comes out, the regulations from the SEC come out, we're not seeing a lot of Bonzi initiatives that aren't doing well. We want to make sure that they're sufficiently they provide sufficient consumer protection for future projects to be associated with that success, and then to see innovation driven from that. Because if a lot of projects come out and take advantage of consumers' lack of knowledge on the space, then we'll probably see backlash from policymakers, and it'll just hurt the ecosystem more.
All right, I'll take a big approach to this question. So on a 10-year horizon, I'm incredibly bullish. I think we're building an adjacent industry for financial instrument issuance and trading back and forth, right? A lot of these same concepts have been around for years, but they're held by large financial institutions, hedge funds, and there's a huge barrier of entry for smart individuals, devs, entrepreneurs to kind of get involved in this space unless you work for, Jane Street, Two Sigma, and some of the big financial firms that focus on these problems. We now have a platform that has lowered that barrier dramatically, and then now we can spin up products and get each other trading on it directly rather than kind of going through those old hoops. And so once we figure out institutional custody, once we figure out some of the regulatory concerns and exchange venues, I think this issuance platform is 10x improvement over what exists today, and so I think it'll definitely win out.
Yeah, so 10 years horizon, and actually I would hope that that's more like a 5 years horizon than a 10 years horizon, is essentially a synthetic financial product that has been fully rated and is completely transparent, that is being sold through a sell order in the US and bought through a buy order in Taiwan and Korea. So this whole connectivity across all exchanges, being able to essentially bring a worldwide aggregated order book where buy orders and sell orders can come from anywhere on products that are fully transparent.
Thanks, guys. Super exciting stuff. As you can see, it's somewhat ready, and I think in the next few months we'll be seeing a lot more issuances. For those that don't know, the Aspen Hotel in St. Regis was actually closed and launched, which is a marquee brand, and there's a lot more to come. So definitely keep your eyes open. I'm going to move it to the audience now and take a couple questions.
Right there, front and the left. Yeah, you.
Wait.
In third row.
Thanks. Hey guys, really interesting discussion. One thing that maybe I'd like to ask all of you guys is, do you think investor behavior will change when you start putting financial assets as a security token? So take an example, bonds, corporate bonds barely trade, right? Super liquid. When you tokenize that, do you think that liquidity is going to boom because it's a different investor class that starts getting in there? Or, what are your thoughts around that? Will we see a change in investor habits?
Yeah, I think that's a good question. The short answer is, in the short term, no. In the long term, dramatically, right? We now have a value exchange that is completely seamless, and the way we're utilizing that today is to build, DEXs, which are fantastic for trading cryptocurrencies back and forth. But I think when you have a DEX kind of behind the scenes and trading is so instantaneous and the investor barely knows it, it's like a shopping experience in the Web 2.0 world. I think investor behavior is going to change dramatically, right? More people are going to be involved. More people from around the world are going to be interested in assets that are on the other side of the world. Buying and selling is going to be a frictionless experience rather than something that has a lot of analysis going into it. So in the long term, I think it's going to change considerably.
Hi, thank you for the talk. I have a question on privacy. So one thing that makes me very skeptical about security token, despite the fact that I'm also bullish on the other side, is let's say tomorrow everything is tokenized. It means that if someone knows my main wallet, they know everything I know, everything I own in the world. And that seems like an impossibility issue to happen for real investors. How you guys think that's going to be solved?
What was the question?
Privacy.
Privacy. Understanding positions, understanding anyone's position.
I didn't hear the question.
Yeah, so privacy is one of the big concerns that kind of comes up. Obviously today we have okay but not so great solutions for hiding transactions or hiding total balances, ZK snarks, range proofs. But I think a lot of those privacy features are actually going to come with the layer 2 solutions, right? So you can imagine having multiple, maybe your positions are spread out amongst 10 different side chains, and then that's kind of how you aggregate your holdings. So the operators of those side chains wouldn't actually have access to your entire account, just part of it. Also with things like side chains, you can do much more kind of opaque transactions in a lot of instances. Off-chain formal verification provides another vehicle for it. So I think it's coming.
Yeah, I think some decentralized identity solutions are going to be very helpful there as well. I'd also say that there's no reason compelling users to put all of their trading activity for every asset that they own or buy and sell into one address. You can spend the time KYCing or otherwise getting registered or approved a number of addresses and, put different things in different addresses so it suits. So I don't think you have to put a complete footprint of your whole bank book in one spot.
I also think that with respect to the GDPR, which we've talked about before, you have to look to what you can actually put on chain even. A lot of this stuff will have to live off chain. A lot of personal information will have to live off chain anyways. So some of the innovation will have to wait for changes in regulation, or at least just comply.
So we're almost past time. We'll just take 2 more questions.
Hi. I have a question about user experience. So whenever you use Ethereum blockchain in any function or with any application, right, there's a question of private key management, there's a question of transaction fees that always comes up. I was trying to do something, my MetaMask transaction never actually reached the network for some reason. I was too lazy to investigate. So how do you think of that level of kind of user experience awfulness as it pertains to a product that is targeting, people who don't have education in this type of thing?
Yeah, so that's a great question. And you talk about private key management. As soon as we start mixing securities and private key management, we start getting into a ethos-breaking moment. In the sense that in the traditional financial world, if I have a bunch of share certificates in my home and my home burns down, I just call the transfer agent, tell them what happened, they void the old share certificates, they reissue new ones, and I'm done. So transfer that into a digitized asset, I lose my private key, now what? Right? So with traditional methods, I don't have any recourse, right? So the question is, let's say I owned 10% of a company and I lose the private key to that wallet. What does that mean? Is the 90% of the company left now 100% of the company? Who owns those 10%? Where does the voting go? Does that all get voided? And so one approach that we took, and that's reflected in the ERC 1400 security token standard, is that concept of a forced transfer. That concept of allowing an approved authority to transfer tokens from one wallet to another. Now that's the ethos breaking moment, right? Because at that point, we essentially give control to someone to make that transfer. That transfer is still captured on chain, is still visible, everyone knows about it, but there is that higher level of authority, which, back to your UX experience, because not everyone knows how to carefully care for their private key, we have to put those mechanisms in place until one of two things happen. Wallets, and there was a good presentation earlier today on the ability to do like multi-private key wallets. Until wallets catch up, investors catch up, or regulation catches up. But today, there's methods to address that with forced transfer, for example.
All right, let's take one last question. Right, that was good.
Thanks. Hey guys. When thinking about use cases like cap table management, I look at companies like Carta, formerly eShares. I don't know if you guys are familiar with it. Who have driven up a ton of demand in the past 5 or 6 years by just moving the cap table off the Excel spreadsheet and providing a lot of the features that you guys have been talking about, like liquidity and some transparency and regulatory compliance, and they've been doing so in a completely centralized way. So I'm wondering, like, why go through the trouble of, in this use case in particular, putting that application on the blockchain, since it's a lot more difficult and people seem to be willing to trust companies like Carta to do this for 10x cheaper than it was possible before?
Yeah, I think that's a good question. A big fan of Carta, love their product. I also, throwing stuff out there, I bet you in the next year or two they come out with a blockchain-based product, 100%. So, a couple things. Number one, is every private company in the world going to use Carta? Probably not, right? The industry will be a little bit more stratified than that. I do think, keeping it centralized has a lot of benefits, but when you're talking about going from, like, say you're Facebook, right, and you have 10 initial employees that had shares, then you're going to, that's going to eventually move to 10,000, then it's going to be an IPO, and then it's going to, you want to get overseas investors involved. I think a platform like blockchain that allows you to kind of tweak those rules over time and kind of change the nature of that security as your company or the thing that represents changes, has a lot of benefits. I definitely wouldn't sleep on the Carta team. I'm sure they're thinking about these things too. But I also think when it's on a blockchain, it's a little bit more trusted too, just because it's out in the open and transparent.
Awesome. Thanks for joining. Thanks all you guys for your time. That was great.